The U.S. economy right now, sitting here in mid-2025, it feels less like a steady ship and more like it's navigating maybe three different hurricanes at once. You've got this massive tech wave, especially AI, potentially reshaping, well, everything. Then prices that just won't seem to calm down, and some truly eyebrow-raising financial stuff happening. It's a lot.
It genuinely is. This period, it's really defined by these powerful, sometimes conflicting forces, the incredible potential of this transformative technology.
Right.
The growing, maybe volatile, but growing influence of digital assets, and then this stubborn challenge of price stability that's hitting everyone. It creates a landscape that's got immense opportunity, but also some very real uncertainty.
And that is precisely why we're doing this. Welcome to the Deep Dive. This is where we take your source material. And today it's a really insightful analysis called Navigating the U.S. Financial Landscape. What investors need to know in mid-2025. And we unpack it.
Yeah.
Our goal, pull out the absolute core nuggets of knowledge, the key insights just for you.
We're trying to cut through the noise here. We'll focus specifically on what this analysis highlights about, the major trends in crypto, the potential economic earthquake from AI and robotics, and that persistent headache of inflation. Everything we talk about today comes straight from this one source.
Yeah, our mission is basically to make sense of these big picture dynamics and then figure out, okay, what are the implications specifically for you? Whether you're actively investing or maybe just trying to protect your savings or even just understand the economic currents affecting your daily life.
Exactly.
Okay, let's unpack this. And I think we should kick things off with a move that definitely grabbed headlines, a huge play in the crypto space.
Yes. This analysis immediately spotlights Trump Media and Technology Group, the company behind Truth Social, and their rather audacious plan.
Audacious is a good word for it.
They're aiming to raise a staggering $2.5 billion, specifically to build a substantial Bitcoin treasury.
Wow. $2.5 billion for Bitcoin. That feels like a watershed moment almost.
It's a big number.
And the analysis, it breaks it down, right? Like $1.5 billion from issuing new stock, new equity.
That's right.
And another $1 billion through convertible bonds. Those are the ones that can turn into stock later.
Exactly. Convertible bonds. And the timing, as this analysis really underscores, it's hard to ignore. It happened right as Bitcoin surged past that significant $110,000 mark.
Okay.
And that timing, the analysis suggests, it has kind of multifaceted implications. First off, there's definitely a political signal kind of embedded in this move. The analysis points out that having a company so closely tied to, a prominent political figure build such a big Bitcoin holding, it sort of reinforces a narrative that potential future leadership could be quite supportive of crypto adoption, maybe even favorable regulation. It positions crypto, according to this source, as gaining real political resonance.
Right. And just so we're absolutely clear here, we're just reporting that as the narrative presented in this specific source, we're not, adding any outside political commentary ourselves.
Exactly. That's crucial. Beyond that political read, though, the analysis emphasizes the market dynamics.
Okay.
Bringing a player the size of TFTG into the Bitcoin market with such a large treasury. Well, it isn't just a small ripple. It can absolutely amplify short-term price swings. But the source also notes it potentially boosts the long-term credibility of Bitcoin as an asset class, simply by having a publicly traded company like this one hold it on their balance sheet.
But with that potential, mainstreaming, that comes with significant risk too, doesn't it? I saw that this analysis includes a section on investor caution.
It does.
Specifically highlighting the vulnerability, right? If you have such a large institutional treasury and the crypto market suddenly corrects, takes a sharp downturn.
That's exactly right. And the analysis suggests this kind of significant hit to a major player could potentially have a cascade effect, impacting broader market sentiment and maybe individual investors who might be following these larger trends.
Okay, so let's bring back to you, the listener. What does this actually mean? The analysis points out a couple of key potential advantages here if you're looking at this space.
Yeah, it suggests that individuals who are already in, or maybe considering getting in early, could see substantial gains if this crypto trend, highlighted by moves like TMPGs, keeps going up. And it also frames crypto as a way to diversify into assets that don't necessarily move in lockstep with traditional stocks and bonds. It's a non-traditional diversification play, basically.
But, and the analysis really stresses, this is a big but, the disadvantages are significant.
Okay.
The inherent volatility of crypto is just It's always there. Regulatory uncertainty, while maybe easing a bit, is still a factor. And there's a real risk of overexposure, right? If crypto becomes too large a piece of your overall financial picture.
Absolutely. So the takeaway is, even if you don't own any Bitcoin yourself, this TMTG move is probably a signal worth watching.
Right.
The analysis uses it to illustrate crypto's push further into corporate America, into the mainstream financial conversation. But it's also a potent reminder of the volatility and the risk that are still central to this asset class.
Okay, definitely something to keep an eye on. Shifting gears now, this analysis takes a look at a completely different but potentially even more impactful technological force, and it connects it to a huge national challenge.
Right. This is where we get into the ideas presented by David Sachs. He's noted in the analysis as a senior advisor on AI and cryptocurrency policy, and he puts forth a rather bold suggestion that AI and robotics could be a fundamental solution to America's significant fiscal problems. Host, speaker. Wow. A technological fix for the national debt? That sounds ambitious. How did the analysis explain his reasoning there?
Well, his core argument, as it's laid out in the source, is that these technologies can dramatically supercharge productivity and significantly reduce labor costs across almost every industry. The big benefit he points to is that this increased economic activity can actually expand the tax base. So more overall income and profit to tax.
Exactly. Without needing to raise actual tax rates on individuals or businesses. It's positioned as a sort of growth-driven strategy to improve the fiscal outlook.
Okay, here's where it gets really interesting. Because while that vision of massive productivity gains is, compelling, the analysis is also very clear-eyed about the immediate, maybe less rosy implications.
Absolutely. The long-term potential for these technologies to, say, revolutionize supply chains, eliminate inefficiencies, even create entirely new sectors. The source notes, that's immense. But the critical short-term consequence, which the analysis highlights pretty forcefully, is workforce displacement.
Right, the jobs aspect.
It states pretty unequivocally that this will happen, particularly impacting lower-skill sectors. And it really stresses that investing heavily in things like reskilling programs and educational infrastructure will be absolutely critical to, well, mitigate the social and economic disruption.
And for investors, this creates a fascinating landscape, doesn't it? The analysis points out that companies pioneering and developing these AI and robotic solutions are naturally positioned for what it calls exponential growth.
Yeah, the potential upsides for investors, according to the analysis, include the chance for early investments in these leading firms to yield, potentially very high returns if the technology delivers.
Right.
And furthermore, the analysis suggests that the increased productivity these technologies enable can directly boost profit margins for companies that successfully integrate them.
But the downsides, the potential hurdles, what does the analysis flag there?
Well, ethical and regulatory scrutiny is a major one. Figuring out how to deploy AI responsibly, that could easily delay widespread adoption.
Okay, that makes sense.
And particularly in the early stages, there's a need for very high capital expenditure. Essentially, these technologies are just expensive to develop and implement initially.
So, thinking about you, the listener, how might this AI revolution impact your job or your industry or even just businesses you interact with every day? Could parts of what's done today be automated tomorrow?
Yeah, the analysis suggests this isn't some distant sci-fi possibility. It's a force that's already shaping industries and creating potential investment opportunities and risks right now.
Okay, so we've touched on the crypto push, the AI earthquake. Now, this analysis pivots to a more, let's say, a traditional but still persistent economic challenge. Inflation. And it looks specifically at the S&P Global Survey findings for May 2025.
And this survey, it presented something of a mixed bag for the U.S. economy. On one hand, it showed an unexpected uptick in overall U.S. business activity, which sounds positive.
It does, and the analysis suggests this uptick was driven partly by maybe easing geopolitical tensions and, importantly, increased consumer spending, people feeling a little more confident, opening their wallets a bit wider, perhaps.
Right. However, and this is the crucial counterpoint the analysis immediately brings in. Despite this increased activity, inflationary pressures are still very much present and, frankly, problematic.
Still sticky?
Very. The source points to specific factors keeping prices high, things like ongoing tariffs and persistently rising input costs for businesses, the raw materials, energy, all that stuff they need to operate.
And the big concern that this analysis highlights, stemming from this mix of sort of slow growth and high prices, is the growing fear of stagflation.
Ugh, yeah. That's the really unpleasant combination, isn't it? Stagnant or at least very slow economic growth happening at the same time that inflation stays elevated. What's striking here, as the analysis points out, is that tension between those two signals.
Yeah.
Business activity picking up, suggesting some momentum, but inflation just eroding the real value of money and squeezing profit margins.
And the source really underscores the strain this puts on consumers, on you. I mean, if inflation accelerates, your purchasing power just diminishes.
Sure.
Every dollar you earn or save buys you less. It directly impacts spending, especially in retail and services.
And this dynamic, it creates a significant policy dilemma, as the analysis notes, for the Federal Reserve.
Yeah, what do they do?
Well, with signs of increased activity on one side, but persistent inflation on the other, they face really tough decisions about interest rates. Raise them too aggressively to fight inflation, and they risk choking off that business activity.
Right.
But hold steady or lower them, and they risk pouring fuel on the inflation fire. It's a very, very narrow path they seem to be walking.
So for investors listening, the analysis does identify some potential advantages in this kind of environment, right? Like potential gains in sectors traditionally seen as more inflation resistant.
That's right. It mentions areas like energy, commodities, and real estate. The analysis also talks about the possibility of short-term opportunities in specific stocks that might become, undervalued during periods of market volatility driven by all this policy uncertainty.
But the flip side, the disadvantages highlighted, include the risk that if interest rates do rise, bond yields would likely follow, which can decrease the market value of existing bonds you might be holding.
Correct. And just overall instability in the stock market remains a significant risk because of that uncertainty around the Fed's next move.
Yeah.
Nobody's quite sure what they'll do.
So for your daily life, this persistent inflation, it obviously hits your wallet every time you buy groceries or fill the car. And the possibility of stagflation or more Fed action, well, that means potential volatility for your savings, your investments, maybe even job security, depending on the sector you're in.
It really shows how these different forces aren't happening in isolation, doesn't it? They're all interacting in complex ways.
Yeah, absolutely. So what does this all mean? Looking ahead, maybe the next 6-12 months, and more importantly, what about your strategy in navigating this really complex landscape? The analysis actually lays out a few potential paths forward.
It does. It sketches out 3 broad scenarios, kind of possibilities. The most optimistic one is called a tech-led recovery.
Okay.
That's where the AI productivity gains really start to take hold, inflation begins to moderate, and the Fed manages a sort of balanced policy that supports growth. A soft landing, perhaps.
The ideal outcome. Then there's a neutral scenario.
Right. Slow growth with persistent inflation. Business activity kind of keeps chugging along, but high inflation cancels out a lot of the benefits. This leads to cautious consumers and requires a very, very selective investment strategy.
Okay. And the pessimistic scenario.
That's stagflation and market corrections. Inflation stays high or maybe even rises. Economic growth stagnates. You get job displacement from automation without enough reskilling support. And potentially sharp drops in asset markets, like stocks or real estate.
Those are some heavy possibilities. But the good news is the analysis doesn't just, present the potential problems. It offers strategic investor tips. We can think of these as actionable takeaways directly for you based on this analysis.
Exactly. And the first piece of advice, it's fundamental but absolutely crucial in uncertain times. Diversify your portfolio. It is, but the analysis stresses this means diversifying not just across different companies, but across different types of assets, stocks, bonds, real estate. And yes, it includes crypto, but emphasizes doing that carefully, with modest allocations. It also suggests looking at geographic diversification.
Okay, diversify. Next, it recommends prioritizing inflation-proof investments.
Yeah, as we discussed, the analysis points to sectors that tend to perform relatively better when prices are rising. Think energy, healthcare, consumer staples.
The essentials.
Right. And also real assets like gold or maybe real estate investment trusts, REITs those companies that own income-producing real estate.
Makes sense. What else?
Staying informed on policy changes is flagged as critical. The analysis highlights that decisions and statements from, the Federal Reserve and the Treasury Department can significantly impact market direction. So keeping an eye on those is key.
Right. Paying attention to the signals. And specifically on crypto, what's the tip there?
The advice is to evaluate your exposure carefully. Acknowledge the high potential reward, absolutely, but also the significant risk. So keep crypto allocations modest, and crucially, only invest what you can genuinely afford to lose entirely.
Sound advice. Anything else on the investment side?
Yes, the analysis suggests Investing in future-forward industries, areas like AI, robotics, green energy, biotech, endocrine, these are identified as long-term growth drivers. The tip here is to look for companies within these sectors that might be currently undervalued but seem to have strong underlying business fundamentals.
Okay, looking for value in growth areas and beyond just market investing.
The analysis reinforces basic personal finance resilience. Build an emergency fund?
Always important.
Always. Having 3-6 months of essential living expenses saved up is just crucial for weathering any personal setback or broader economic downturn, regardless of what the markets are doing.
Absolutely. Any other practical strategies mentioned?
One more for navigating volatile markets. Consider dollar cost averaging, or DCA.
Ah, yes, DCA.
This just means investing a fixed amount of money at regular intervals, say, every month, regardless of the market price. It helps reduce the risk of trying to time the market perfectly because you end up buying more shares when prices are low and fewer when they're high, averaging out your cost over time.
Okay, a disciplined approach. And the last tip.
Finally, the analysis advises keeping a close eye on consumer behavior trends. Watching how and where people are actually spending their money can signal shifts in the economy.
Like what?
Well, it could point to potential opportunities in sectors that are growing, maybe increases in spending on digital services or health and wellness products, things like that.
Interesting. So these aren't just abstract ideas, are they? The analysis really frames them as concrete strategies derived right from its findings, steps you can consider to navigate these complex economic waters.
Exactly. And potentially turn some of this uncertainty into opportunity.
So as we wrap up this deep dive, the picture of the U.S. economy in mid-2025, as painted by this analysis, it's undeniably complex, full of contradictions, really. We're seeing this immense promise of technological leaps, like AI, right alongside the potential for significant job disruption. We've got signals of increasing business activity bumping right up against the very real, persistent challenge of inflation.
Yeah.
And we have these bold new financial moves, like TMTG's Bitcoin treasury, existing within a market that's still grappling with fundamental volatility and uncertainty.
It's a lot to juggle. And the source's conclusion provides, I think, a strong takeaway message. For all of us, whether we're active investors or just individuals trying to, make ends meet,
Yeah.
the challenge isn't simply to survive this turbulence, but to actively adapt and really aim to thrive.
How?
Well, according to the source, it means staying informed about these converging forces, approaching our finances with wise diversification, and aligning our strategies with those forward-looking trends that the analysis identified.
And by doing that, the analysis suggests it's possible not only to protect the wealth we might have built, but also to find avenues to grow it, even in these times of significant change. It really emphasizes the need to kind of sharpen your financial strategy, look for ways to build personal economic resilience, and just know where to look and how to act based on the clearest possible understanding of the information at hand.
Which leaves us with maybe a final provocative question to consider, building on the points made in the analysis.
Okay.
We heard that AI and robotics have this tremendous potential for productivity and wealth creation, but also significant risk of causing job displacement, particularly in lower skill areas.
Right.
And we also heard that increased consumer spending is currently one of the drivers keeping business activity afloat.
Yeah, that tension again.
Exactly. So how might widespread automation-driven job losses eventually impact that very consumer spending that the economy seems to need to keep growing?
Yeah.
Is there a potential fundamental conflict there between the push for maximum technological productivity and the need for robust consumer demand in the scenarios ahead?
That's a really interesting thought. Definitely something to mull over as you navigate your own financial landscape.